Hello, everyone. Today on the Final Bar, I'm talking with Dan Russo of Potomac Fund Management in New York. We'll see what sort of charts he's looking at to make sense of this market. I would argue still very much in transition, right? We have a choppy sideways phase. What stocks, what charts are getting it done and which ones are struggling? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit was designed many decades, if not centuries ago, and refined over time to help you really understand investor psychology, and that's really how I think of it. I learned psychology first as an undergraduate when I learned that there was a set of tools to help you understand investor psychology and quantify investor behavior. I was totally hooked. And I've certainly found over my time in the industry that charts have a beautiful way of illuminating what investors are doing, those fear and greed-driven decisions that cause asset prices to go higher and go lower. We're going to break down a lot of the different charts. We have a great guest today, Dan Russo, who has been on StockCharts TV before, but it's been a little while, so we'll get his take on what is important. Let's get right to our market recap. When we're looking at the markets today, what sort of evolved, sort of a choppy day, net negative for the most part. Yesterday, sort of pushed higher. It's sort of been this slow, steady drift to the upside as the S&P pushing above 4,100. It almost felt going into the 3 o'clock hour we were going to hit 4,100 from the upside. There was a lot of downside momentum, a bit of a bounce going into the close. But overall, the S&P finishing down about 0.6%, just below 4,130. The NASDAQ composite underperforming, down about 0.8%. Mid caps and small caps all down about 1/3% as well. The VIX actually moving higher, which is pretty unusual for I think an average day here in the last couple weeks. It's been a VIX going lower. Went below 17 yesterday for the first time in quite some time. You have to go back to 2021 when the VIX has been around these levels before. Bit of a bounce to the upside today as stock prices went lower. So we'll see. That's certainly a potential move to keep an eye on, because so far, the story in April has been kind of a slow and steady incline to the markets, with volatility remaining relatively muted. We'll see if that starts to change. For now, we're seeing a bit of that. Looking a little bit at interest rates, you can see that the 10-year yield, the 5-year yield, the 30-year yield, and the short-term yields all in red, all moving lower. So essentially, the entire yield curve kind of drifting lower through the course of the day today. 10-year yield's down around 355, long bond yield around 375. Of course, all of that much lower than the short end. So we still have that inverted yield curve we've talked about with a number of our guests here recently. Bond prices, of course, moving higher as interest rates are moving lower. And the dollar index, not much change, actually flat using the UUP. That's a bullish dollar ETF we like to use. Commodity space, net negative, although we're a couple bright spots. Natural gas ETF was up a little bit. Gold prices up as well. The GLD was up 0.4%. Silver on the other side was down about 0.25%. But, gold, again, year to date, you look at what charts are clearly outliers on the upside. Hard to find one that's a better example than gold. Maybe semiconductors, maybe something like that. Maybe home builders now kind of making new swing highs, new highs for the year. But gold certainly has been one of the stronger places. And for today, continuing to lead to the upside. Cryptocurrencies, another day all in the red, and that's following through from yesterday's day, which was sort of a destructive day with Bitcoin moving down below 30,000. Today we have Bitcoin approaching 28,000 from above. So that's down another 10% from earlier in the week. You can see looking at Bitcoin down 2.3%, Ether not as bad, down 0.4%, but the other coins that we track out of about 160 that we have on our platform, all in the red today. Let's look at a chart of the S&P 500, then we'll get to some sectors and some names on the move. Of course, we're sort of getting into the meat of earnings season. We're still sort of in the early days, but more and more you're going to find news flow is related to earnings. Tesla's earnings after the close yesterday, putting a lot of weight on that particular stock. We'll look at that here in a few moments. But what we're going to do on the chart of the S&P is just reinforce some of the levels that we've been talking about, right? When you're looking at the chart of the S&P, when I'm looking at it, I'm keying in on some key levels. And again, one of the reasons why this show is called The Final Bar, besides the musical implications, which gets to my background and how I like to approach and sort of my life experience leading into my analysis in the markets, it also has to do with the importance of the final bar, that last bar, right? I always teach people, start with where we're at today and look to the left, right? And the further you go left, I would argue the less and less meaningful those levels are, right? And if you're thinking of support and resistance, start at the final bar and look to the left. What levels stick out? Which highs, which lows are, have meaning as the market has told us? And we can see very quickly, 4,100, of course, in sort of the shaded area in blue has been a significant level. We're now above that. So the question is, do we hold that level? That's question number one. Question two, do we break through the next resistance level? 4,200, of course, a clear resistance level. That was the high from early February. For now, that's been the high of the year, although a number of individual stocks certainly have eclipsed their February highs and have started to push to new upside for the year. The S&P, the NASDAQ, still sort of holding below those February highs. For the S&P, it's around 4,200. So if and when we get above there, that's when we can start to engage further upside targets and think about what happens next. On the downside, right, this is an assumption that we're going to hold 4,100. Now, I haven't talked a lot about support because the average day's been moving higher here. The average week has been pretty decent from mid-March to mid-April. Today, of course, I'm starting to look down and say, all right, how far did we draw down and what levels do I want to watch? And 4,100 to 4,050, that's the blue shaded area. The 50-day moving average not too far below, around 4,034. And I think holding those levels, certainly pretty significant. As long as we hold those levels, how bad are things getting? We start to break those levels. I think you really need to think about the potential to retest lows for the last 6 months and sort of open your mind to further downside support. My guest, Dan Russo, we were talking before we went live, and I've mentioned a number of times, look at where the S&P is at versus 6 months ago, versus 10 months ago, versus 12 months ago. My answer is not much different. His point was, go back even further, right? Let's keep going and think about, draw a line from the current level and look at how far back you can still line up these same levels. This entire period has essentially been a rotation, overshooting 4,200, now undershooting 4,200, kind of right back to these current levels. So, again, while there have been arguably career-busting moves along the way, in the end, this has been sort of a sideways market for quite some time. Now, what's fascinating about that as the backdrop is that there are individual names, there are stocks, there are ETFs that are certainly showing strength and weakness all along the way. What happened today is consumer staples ended up being the only one of the 11 S&P sectors in the green, finished up about 0.25%. Everything else was sort of flat to down. What really led the way lower were three sectors: consumer discretionary, real estate, and communication services, all down at least 1% today. Consumer discretionary, the XLY, the worst performer, down 1.5%. Now, what you have to remember with any of these, and I'm thinking particularly about the XLY, the XLC, the XLK, these are very mega cap dominated ETFs, and these are cap weighted ETFs. So the XLY is essentially Amazon, Tesla, and Home Depot. Those three stocks are probably about 50% of the weight of the ETF, would be my guess. Not really thinking of them in terms of recent percentages, but I bet it's about that, 45 to 50%. So when Tesla is down almost 10%, that is going to weigh pretty heavily on the XLY. Communication services has a stock called AT&T in there, which is down over 10%. So those types of names, particularly in the growth sectors like consumer discretionary, communication services, technology, they're really dominated by a couple names in each one of those. If one of those is having a tough stretch, it's really going to hurt the performance of that group as a whole. Let's start with Tesla here, and we'll look at a couple different stocks with the time we have remaining in our market recap. But, we've had this, what I'd call a pennant pattern illustrated on the chart. You can call it a coil pattern, maybe a symmetrical triangle, depending on what time frame you're looking at. But essentially, it's an equilibrium. It's a consolidation pattern. And what that means is you had a big move in January, sort of first 6 weeks of the year, we'll call it to early mid-February. From there, we have this pattern of lower highs and higher lows. So again, just think about what that means. That means in late January, early February, we reached around $190 a share. And from there, the market has been overshooting and undershooting that equilibrium. And I can say that with confidence because that range is narrowing right around that midpoint, kind of right where the 50-day moving average is today. So what happens in that environment? This is something John Bollinger spoke about years ago when I was learning the technical toolkit. is before you have a big break, you have this period of lower volatility, right? As things sort of consolidate, this is sort of the waiting period, the calm before the storm, and then there's usually a big move. And with a pattern like this, one of two things can happen, of course, right? We can break above the upper boundary and break the pattern to the upside. And that's actually usually what happens with this sort of coil pattern, because it's thought of as a continuation pattern, meaning you have a big move, this is the pause, and then you have the continuation and you usually extend it. What's happened with Tesla with the gap lower today, and arguably with the sell-off we had earlier in the week, is we've now broken the lower boundary, and what that suggests is more downside, right? It's telling you that the momentum is shifted more to a bearish phase and pushing Tesla to the downside. Not a great look for Tesla, of course, with their earnings release and just seeing the technical implications coming out of their earnings after the close yesterday. Also not great implications for consumer discretionary because Tesla's a pretty big weight. So if you have exposure to the XLY, it's going to be tough until a chart like Tesla starts to really improve. Now, in that same group, you have something like Amazon. Now, Amazon is not a horrible chart year to date. It's up. However, is this chart at a high level kind of bullish or bearish? And I think you could make an argument on either side at this point. But what I'm looking at is the fact that it's been below the 200-day moving average pretty much 100% of the time since the fourth quarter of 2021. We've had a number of attempts to break above the 200-day, and every one of those attempts has failed. You know, if and when we finally break above there, that's when a chart like Amazon looks pretty constructive, but I don't think we're there yet. And the challenge for the XLY is two of the biggest names in the ETF are struggling on a relative basis for sure, but on a technical larger basis as well. Let's pivot a bit and talk about some of the charts that maybe are starting to work. I might do one or two of these and then I might go to another one, but we'll see what time we have left. Gambling stocks are some of the few that are actually moving higher. LVS gapping higher today. A couple of these are earnings names. I forget. I didn't jot down exactly when all of them reported, but you can see LVS gapping above $60 a share. That's taking it above resistance that we've seen year to date fairly consistently. Win in that same group. Also sort of testing those levels, not quite breaking out, but sort of holding an ascending 50-day from now. So what's interesting in a market like this is you have AT&T and Tesla gapping lower. You have charts like gambling names and others that are actually holding up. I would argue the technical question you should be answering using stock charts every day. What's working? What's not? How can I lean into what's working? How can I lean away from what might be struggling on a relative basis? That's it for our market recap. I want to come back from our break talking to our guest, Dan Russo of Potomac Capital. We'll see you in a minute. Hey everyone, welcome back to The Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. We appreciate you joining us every weekday after the close. We're going to bring on today's guest, Dan Russo, in a few moments, but I want to start with a couple quick announcements. First off, we'll do a mailbag segment on Friday's show, and we'd love to feature one of your questions live on the air. Best way to get your questions in front of us is via email. thefinalbar@stockcharts.com is the best way to contact us. We're also on Twitter @FinalBarSCTV, so just tag us in a comment there. We are on YouTube, so subscribe to our YouTube channel, won't you? And also, while you're there, put a comment below the video you're watching. We'd love to hear from you. Hope to answer one of your questions live on the air on Friday's show. Upcoming schedule. We'll be doing a mailbag tomorrow. Next week, I'll be heading to New York with some of the Stock Charts team to be a part of the CMT 50th Anniversary Symposium. I will see today's guest, Dan Russo, among many other fellow CMTs at the conference. So Tom Bowley will be hosting the show remotely. He has three really good guests for you. Bruce Frazier will be joining him on Tuesday the 25th. On Wednesday of next week, Arthur Hill. And then on Thursday the 27th, Aaron Swenlin. Then Friday, April 28th, we will be coming to you live from the CMT Symposium. I will be interviewing Ralph Acampora and Louise Yamada live from the stage. It is going to be an absolute blast. We had a talk with Ralph, Louise, and some of the CMT folks to make sure we get it all happening. We'll be broadcasting live at 1 p.m. Eastern. We'll replay the episode later in the day as well for all of you, but I hope you can tune in live. Should be an absolute blast, and congrats again to the CMT Association for 50 fantastic years of promoting technical analysis in the industry. Speaking of which, let me bring on one of the accomplished technicians that I have a pleasure to speak to on the show, Dan Russo. Dan is a portfolio manager and director of research at Potomac Fund Management, coming to us from New York. Dan's a former host on Stock Charts TV. Actually hosted a show that we broadcasted. Dan, it is great to see you, and welcome back to Stock Charts TV.
It's great to be back here. I feel like it's my old stomping grounds. I think I had a show here for 2 or 3 years, right?
That's absolutely right.
From my previous seat. So it's so good to be back, and I'm looking forward to catching you in person next week as well. I didn't realize that you were doing that interview with Ralph and Louise. I would strongly urge anybody to catch the replay of that. I mean, I mean, you're the rookie on the stage at that point, right?
At 23
I mean,
years in, I'm like the junior member of that
yeah,
group, which is going to be
you're
humbling,
like,
but it's going to be
I
fun,
was going to
right?
say, you're like the junior analyst
It's
there. You're
true.
running out
It's
and
true. I'll see what
getting the
insights I can pick up from some experts while I'm on the stage there. But no, it'll be awesome to see you,
unbelievable.
Dan. And for the CMT community, it's going to be great to get everyone together again.
Yeah.
It's been a while, I know, for many of us. Let's get to some of the charts that I think are helping us understand how you are approaching the markets. We're starting looking at the technology sector. This has been, of course, in January, February, March, by far, I mean, one of the strongest places to be. What do you see now? We're sort of approaching resistance. What's your take on tech here?
So my take on tech here and kind of my take on the market broadly is you kind of hit on it. You drew that line that goes back 2 years on the S&P 500. And for us, what we're looking at, what we see is we see a ton of conviction on both sides of the coin. And at Potomac, sometimes we're talking back and forth, myself and our CIO, Manish Kata, like confused as to where all this conviction is coming from. I hear from people who are bearish and they talk like the world's coming to an end and they're sure of it, and people who are bullish and they talk like it's puppy dogs and ice cream and they're sure of that. And one of the things they point at is what you just alluded to, this strong run in tech, right? You were talking about the weights of Tesla and Amazon inside of discretionary. Well, how about the weight of tech inside of the market? 25%, 27% of the S&P 500. But what I see here is a group that arguably has a bullish tilt. You have your golden cross with the 50 above the 200-day, but you have not broken above those September, October highs just yet on an absolute basis, and on a relative basis, having a hard time getting through the late 2021 highs. And what's fascinating to me is when did the market top? The S&P 500 topped on, I believe it was January 4th, 2022.
Yeah.
Right. So I think it's hard to make a bull case on the quote unquote market without technology. That being said, obviously there's opportunities all around the market at the individual stock level. You talked about gold, you talked about semiconductors, but I think the fact that those two groups are the ones that you're talking about having breakouts kind of speaks to my point of utter confusion in the market. The fact that gold and semiconductors, right, I mean, are working at the same time kind of tells you that, I guess, if you want to make the bear case, you can, and then point to the relative safety of gold. And if you want to make the bull case, you can point to semiconductors, which, I argue is one of the most important industries in the world. So I think tech, if you're bullish, I think you need this breakout in tech on both an absolute and relative basis if you're bullish the market. And the fact that we haven't had it yet gives me a little bit of pause, especially with that relative trend starting to roll over a bit.
It's so interesting. I think you're right. So I feel like in our careers, and you and I have talked about this in previous years, right? Sometimes when things just kind of are all clicking, it makes sense. Arguably, like mid 2021 might have been one of those times where it just felt like minimal drawdowns, things are kind of working. Arguably, mid 2022, things kind of were all lining up on a bearish phase. Here's one where it's a little cloudier, if not a lot cloudier, right? You're getting some different leadership themes. You're getting defensive stocks leading a lot, even when the market's rallying. Not to get too far away from talking about technology, but on certain days you've had things like utilities, real estate. You mentioned gold stocks, and some things you would traditionally consider fairly defensive, even healthcare. How much of the defensive leadership, not just tech working, but some of those other things working, how much of that plays into, I guess, the confusion of these markets?
I think it does play into the confusion of the markets. I think the knee-jerk reaction from most people is to see defensive pockets of the market working and immediately assume that that's bearish. I don't always think that that's the case, because I think that one of the things that ties a lot of the defensive pockets of the market together is interest rates. Now you've had a pullback in rates, kind of the catalyst for that being the maybe it was, maybe it wasn't regional banking crisis. So I think the rate component there maybe throws a little bit of a wrench in the work. And I remember, listen, I don't remember exactly what it was, but I remember there was a CMT event in New York City where you were presenting and you actually made the case that the S&P 500 could still do well, and with utilities leading. I recall that it was a few years ago. It was definitely pre-pandemic.
Yeah.
But I think that I think this is an environment where you have to kind of check your preconceived notions at the door, and just really focus on price, really focus on relative strength, because some of the old relationships might be starting to break down. And I think this is a good segue into the next chart that I brought. I think that one of the reasons that old relationships are starting to break down is inflation. I think we're in an inflation environment that, I mean, realistically, most people involved in the markets have never seen, right? We've had this persistent decline in inflation, not deflation, but disinflation. And with that, a decline in interest rates over a 40-year period, and that may be changing. And if that's changing, obviously that's going to have massive repercussions for pockets of the market. And what I think is interesting here, and I think what's been driving the tech outperformance up until recently, is that there is this narrative out there that it's been mission accomplished somewhat on inflation, that inflation is rolling over. The CPI has come in from, having a 9 handle to now having a 5 handle, and we're going to be back to 2% in no time. And maybe that's the case, maybe that's not. But if that was the case, if that was the foregone conclusion, somebody would have to walk me through why this chart's holding up. This is short-term tips, right? 0 to 5 year tips relative to the broader bond market, the Barclays Ag ETF, right? And it's kind of chopping sideways. It's caught a little bit of a bid of late. You have a bullish divergence at those February price lows with RSI. So, if you think tech is going to keep working, this line has to continue to go down, in my opinion, right? If you think the Fed is getting close to pausing, which the bond market seems to be telling you, the bond market is calling the Fed's bluff. And I just think you're in an environment where most people have never seen it. I've never seen it. Inflation has not been a theme in my career. When I started full time at the New York Stock Exchange in 2000, probably you and I started about the same time, I believe.
Yep.
Right. And so inflation has not been a theme. Rising rates has not been a theme. It's not been something we've had to contend with. Right. So anybody kind of our vintage and younger has not dealt with this before. And you've had these relationships that have built up, right? Interest rates down, tech up, right? Growth up, bonds up, stocks down, right? That's a relationship that we've been pounding the table on for over a year that could be breaking down largely due to inflation. So I think you need to be paying attention still to inflation. Maybe it's mission accomplished. I hope it is, right? Because it was a better environment. It was kind of, I'm not gonna say easier because it's never easy. Yeah. Things just kind of made more sense. But if inflation proves to be a little bit more persistent and this relationship starts working higher again, I think you're going to see a lot of those relationships that people have come to rely upon start to break down. Look, at Potomac, we love intermarket analysis, but we go back as far as possible and we look at intermarket relationships and how they change based on different interest rate and inflation regimes. And those two variables are the biggest drivers that will tend to catch people off guard. But I think it's a great environment for focusing on relative strength.
Let's talk
which
about
I know you're a huge fan of.
Absolutely. And let's talk about your third chart. Speaking of relative strength, talk about non-U.S. versus U.S., right? And this is I think investors, you talk about how investors are just sort of very comfortable with the narrative. U.S. outperforming non-U.S. has kind of been a narrative we've all gotten so comfortable with. That's starting to change a little bit, says your chart. Talk us through this one if you could.
It does look like it's starting to change now. I'm very cautious not to jump the gun here. And I preface that by saying nobody wants to see international outperform more than me. When I was a market maker on the NYSE, I traded ADRs, right? So US listed foreign stocks. I have my MBA is in international finance. I'm infatuated with the global connectedness of markets, but at the same time, we have to focus on relative strength. And for 15 or 14, it's probably been 15 years, the U.S. has outperformed, and that's evident in this chart. This is the ACWI ex-U.S. relative to the ACWI, which includes the U.S., right? So the underperformance that you've seen for 15 years is largely a function of U.S. outperforming rest of world. Right. And that's kind of changing right now, which again is something that nobody is used to, right? Even if you are working with, kind of passive investing, if you've had international exposure in your passive strategic portfolio, it has been a drag. You're probably looking at this thing as a drag for 15 years, and maybe you're looking at your advisor and saying, wait, why is this here again? Maybe that's starting to change. But again, I think if it is starting to change, it's largely a function of the interest rate environment. The rest of the world, right, goes back to my first chart. The US is tech heavy, right? So if tech breaks out, this is going to be wrong, I think. Right. But rest of world, maybe with the exception of Asia and largely China and South Korea, is not as tech heavy as we are. Right. China is obviously tech focused and South Korea has Samsung, which is, I don't know, maybe half their market. or
Right.
close to it, right? So away from that, though, Europe is value centric, right? Latin America, South America, those are, that's materials, that's mining, that's still value cyclical centric, right? And I think what's driving that cyclical nature of markets is always going to be interest rates. So if inflation proves to be a little bit more persistent, right? If we didn't break the back of inflation and rates are going to be higher for longer, even though the bond market's calling the Fed's bluff, this is an area of the market that I think could do well on a relative basis. And I think we have to remember what relative means. Maybe that means down less. And for people who have to be invested by mandate, this is the golden rule, right? You know this from your time in previous roles. If you have to be invested, find what's least bad. And hopefully this is a nice uptrend without performance. But in the case that it's not because of higher rates and inflation, well, then, you can probably get some outperformance in a declining market like you have here.
Dan, you've hit on about 12 different things that I would love to dig into further. This was fascinating and touched on so many of the key themes that I think are important, but you did it in a visual way that I really appreciate. It is awesome to see you. Welcome back to StockCharts TV. We'll do it again, and I'll see you next week in New York, all right?
I'll see you next week. Safe travels.
That's Dan Russo. Dan's a portfolio manager, director of research at Potomac Fund Management in New York. I've known Dan for a number of years, and we've often had just side conversations about the challenges of following the markets, where we're seeing strength, where we're seeing weakness. I think that was a masterclass in how to think of some of the longer-term themes, the prospect of inflation, and what non-U.S. versus U.S. means on value versus growth. That's a theme we're probably going to dig into more because I thought it was very, very well put. But we have to wrap the show, folks. Go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I love Dan Russo's take, thinking about the S&P 500. Think about the sideways sort of environment and looking for the charts to prove that they are still going higher. Technology approaching those highs, but not quite breaking out yet. I'm here illustrating what we call the new Dow theory. Charles Dow looked at the Dow Industrials and the Dow Transports. It was the Dow Railroads at the time. We've adapted that, looking at the S&P 500 representing the old economy, essentially, and the NASDAQ Composite, sort of the new economy. Are these in agreement? Both of them broke to new highs in February. That was a big thumbs up, confirmed bull. Now they're once again testing their highs, this time from February. Neither the S&P or the NASDAQ have closed above their February highs just yet. Both of them do. This is a confirmed, I think, continued bull market. They fail here. All of a sudden, it's sort of a non-confirmation, sort of a lack of bullish follow-through, which could be a cause for concern. Chart number 2, one of my clients actually at Market Misbehavior sent me a chart with some questions that led me to this particular visual I'm going to show you. But we were talking with some of my guests this week about the percent of stocks above their key moving averages. We talked about how at this point at the close, we have 60% of the S&P above their 200-day. We have 57% above their 50-day moving average. Look at where those levels were when the S&P was testing 4,200 in February. We're up to around 75% above their 200-day. Now it's only 60%. We were at about 80%, 75% above their 50-day. Now we're down to 57%. So less stocks participating at this point in the uptrend versus February. That's an interesting way to look at that data I'd not thought about before. Finally, gambling stocks. I mentioned in our market recap some of the names working, some of the names struggling. Tesla, AT&T gapping lower. So it's not hard to find stocks that are actually rotating a little bit lower. But there are charts that are getting it done and stocks that are showing strength. As always, I encourage you to focus on relative strength. Focus on the value of recognizing names that are doing better than the average stock, which is what that's telling you. This is the Dow Jones Gambling Index, which includes names like Las Vegas Sands, LVS, Wynn Gambling, WYNN, and others, holding above the 50-day moving average. Can they get to a new swing high from early March? I think that's an important metric to watch. Folks, that's a wrap for the show and a wrap for the final bar today. Special thank you to Dan Russo of Potomac Fund Management joining us from New York. Some great long-term charts. All of our previous interviews can be found for free at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.